Good evening, all. Ira Epstein, and here we are with your Spider ETF stock market wrap-up for this last trading day of February 2028. It's not really that 2023. It's 2/28/2023. My mind's, I was just thinking, Chicago, the election, it's 7 o'clock. We start hearing who it is. I'm praying that we get rid of this mayor that we've had. So my mind has been on that, and I admit it. I'll bring it back in. I want to remind you all that come Thursday, we have our live webinar. So if you haven't gotten an invite from me by now, you're not going to get one. It means you're not on my list. That's not a problem. Take your cursor at any point as this is going on. Move it to the top up here. You'll see an icon appear. Give a click on the icon. Fill out the form. You'll be sent back immediately your user ID and password. And in addition to that, very important, there's an area on that form when you get back your user ID and password where if you click on it, you can write me direct any questions you want me to cover of markets. Please do that. Give me your spiders, your ETFs now so I can build the charts and go through it. It's only a 20-minute webinar. I'll open the webinar at 12:15, begin it promptly at 12:30, end promptly 20 minutes later. So that's the window of opportunity you have. It is not recorded to be on a website. You either attend or you miss out. All right, so let's take a look at what we've got. When you take a look at all the markets, it was a mixed day, but there's a difference that has happened. Whether it stays this way or not, I don't know. But the market changed its character after February 3rd, not far ago, okay? 3 weeks ago, where it started to wobble. That December rally that came in at the end of December and exploded in January, right? One of the strongest starts to a year we saw, petered out then. And now what's been happening is as the economic data of the month has been coming in and we're seeing that it's starting to do what? Two elements. It is weakening in certain areas, but the labor is so strong that it's going to force the Fed hand to keep going with interest rates. The Fed isn't worried about PMI numbers and the like because they're not strong. They're weakening. That's the lag effect, but it's in the manufacturing sector. The strength sector has been the service industry, and it's only going to get stronger unless the lag effect suddenly shows up. But I think stronger and muted because at the time of the year it would normally go into a lag, people are going to hire. And they're going to hire for all the summer and spring positions. How do I know? Well, if you drive your car in Chicago, you're hearing already the Chicago Park District is taking applications for blah, blah, blah. Do you want to clean parks? Do you want to do this? Do you want to do that? There'll be a fair for people that want to work at outdoor restaurants, and you're hearing these things happening. That's Chicago. It's going to be all over the country as you need people. And even the manufacturing sector that's weakening, they're petrified of getting rid of too many people. They won't be able to get them back. So labor is going to stay strong. I don't see that really change. And that has got the interest rate sector on fire. 6-month T-bills are what, up to 5.17? That's the equivalent of inflation. So if you were to just step there for 6 months, you've pretty well protected your money and you've covered yourself on that. Now, I don't know that inflation won't go higher than that or what it's going to do, but it's awful hard to want to risk assets on certain things, your money, trying to bet that the stock market's going to go up when you already got over 5% locked in. And that's the headwind the market is going to fight. March 7th, Fed Chair Powell goes to Capitol Hill. He'll testify on the state of the economy before the House and the Senate. You know it's going to get very interesting. I can't wait to watch it. It'll be fun. I'm going to stay with SPY just because I want to, as the market's in a breakdown right now, or an attempted one. If you take a look, you see you've got lower highs, lower lows. You've certainly broken down this area. Now, if we come here, you can see where the breakdown occurred. We were up here and I said, there'll be consolidation. You don't believe me? The videos are on YouTube. Take a look. Now the question is, which way was it going to break? It decided to go to the downside. Decided to go to the downside, and this is what you're getting. So where are the levels of support? But before I do that, let's talk about this. If the market were to get out and over Monday's high, you would break this pattern of lower highs, lower lows. So that's a number the bears are going to defend. If the market continues down, the support comes in first, the closest of the main moving averages under the market. That would be 393.13, the 200-day average. Then in green, the 100-day average at 390.96. Those are your supports. I always look to see where the Bollinger Band is with it because 95% of the time the market will trade within a Bollinger Band. And I believe that the smart professional traders program that when the market's hitting it, they're taking money out on the upside. When it hits it on the downside, same thing. They're not getting short against these numbers. If they sell bounces, it'll be well away from that number and then covering it again over and over and over. Now, you are oversold. You're coming into support. Now we get to see just how much support comes in from the, what should I call these people? The value seekers. Those that think, well, we're going to hold that number. It's a 200-day, it's a 100-day average. No, I don't want to be short. I think it'll hold it. Maybe I'll even buy something. But I do think the bears will come out. In UGA, all right, I'm getting the action I want. If you'll recall, I made a statement to you that I do not think you're going to take this number out again anytime soon, if you take it out before the spring-summer driving season. I'm now getting the first signs where the market has gotten over the 18-day average. The pattern is trying to be one, it's not there yet, of a higher high, higher low. You're in the churn. If you were to get a pop here, the big resistance, 60.68 to 61.03, but I am looking for you to be long this market. I think that because of how nature is. Today I was out in the backyard with some people that had to do work for me. It was 55 degrees in my backyard. This is February 28th. I already saw the flowers are coming out of the ground. This is not usual in Chicago. We're 3 weeks ahead minimum. I have lilac bushes. I'm looking at the buds and they're green already. I mean, this is unbelievable. Easily 3 weeks early. How do I know? Because I love to garden during the day. I run away from the markets. I clean my brain and then I come back. Nothing like nature. And I'm not good at anything I do in the garden. NVIDIA. Okay, I think you're at a big resistance point. The market's had its big run up. It's gotten to the Bollinger Band, and now you're getting price distribution. You either embed to add another leg to the upside, or this overbought will resolve with the turning down, and the market will turn down a bit with it. I didn't say bearish, but it could go back to the 18-day average. In Tesla, tomorrow's the big day. Everybody wants to know, are there statements? What the earnings look like? Manufacturing, where are they? The pattern, lower low, higher high. I'll let somebody else try to figure that one out. In XLF, as we come down to the Bollinger Band, you had how many days under? 1, 2. I'm not sure that day was under it, but even if it were, you started popping back over and you're oversold. Too hard of a market. I see the bearish bias, but it's too hard of a market to get involved in. XLI just turned the trend down. Now you've got lower highs, lower lows. So unless you get back over yesterday's high of 101.97, you open the door up for the potential, not of a big break, of 99.97. You're caught in the sideways action of the Bollinger Band. Don't go being a hero. It's going to break out of the up or down side. Often it stays there and spins a bit. I'd rather you chase it. Same in stocks. You not see the sideways action of the bands. What you're doing, you've decided that instead of fighting the battle, and for the while this was it, let's stay over the 18-day and go to the Bollinger Band. Now it's let's get under it, but we don't get to the Bollinger Band. Still a stronger market than weaker. That's what that tells me. XHB, the home builders, well, those that are building homes are making money, but they're getting the money up front. They're not going out and saying, okay, let's do a sub-development on the spec. Number one, I don't think the banks would give them the money to do it. Number two, they're not going to use their own cash to do it. But people need homes. Now, rents are falling. They're down about 3% at this time from where they were about a year ago. Unfortunately, they went up about 20%. So they got a ways to go down to get back to where they're at. I mean, it was a landlord's market. You want to rent it? Fine. If you don't want it, this guy does because you can't buy a home. That hasn't changed. So these little bits down. What has changed? Supply of rental property. Look around big cities. There's high rises going up. I live in one everywhere. They're not condominiums, friends. They're rentals. So the amount of rentals out there creates, just like any commodity, more supply, limited amount of renters. Price comes down to find the renter with the supply. It gets put together. When you look at the energy sector, you're getting your bounce away from the Bollinger Band close to the 200-day average. A bear market rally is all it is. Why? Because you're under the 18-day average and staying there. However, oversold as can be. Now, if you did look today, in fact, if you've looked at the past 2 days, you've seen a very nice short covering rally hit in the energies. I'm talking the gasoline. I am talking the crude oil and natural gas. Whether it can stay if interest rates keep going up, I have my doubts. I mean, the headwind is there. Interest rates are like a tax. They stop the buying of certain things. In GLD, you still have the embedded reading. So this is a bear market rally until the red line closes over 21. I think the pros will sell it, looking for the market to come back down into the 160, let's call it 166.45 area. Right in that zone. In SLV, well, you're at the support areas, so you can get a bounce, but you're embedded. Do I think the pros are going to sell this market hard at the 18-day average? Oh, yeah. If the red line if it's not over 20 at that point, if it gets up there. Now, you're getting a bearish crossover. That's more bearish. In other words, the 18-day just got over the 100. One of my clients was talking to me, hey, Ira, I'm seeing crossovers like this. I don't think they're anywhere near the importance of when the 18-day crosses. And that's because it's crossing latitudes of either 50 days or 200 days at a time. And the market is looking always at the 18 or some people use the 20, but it's looking at that as the big one. And that's how I view it as well. In the copper market, you had a bear market rally that carried up to the 18, fell back to the Bollinger Band, got bought, oversold, and getting a little bounce, but no trend that makes sense there. In TLT, are you going to lose the embedded reading? So they're still embedded. You have your full bet reading. The pros are selling this until you get a settlement over 21. So they'll hit this market higher. My guess is you'll be near the 20 level when you reopen in the morning. Whenever you close at the high of a day, on a day that has some leg to it, some length from the high to the low, which this one did. You went from 128 to 101.72. You generally then will lift that. Would I want my clientele to sell if you're over a 20 level in the morning? No. But if you're not, that's where they're going to hit this market. So fair warning. At least that's what I think. In the dollar index, no reason you can't go up and challenge that resistance. A warning sign to me would be taking out today's low either Wednesday or Thursday. If you've taken my outside day course, you understand that, and away you go there. And in FXE, you tried to lose the embedded reading today. That didn't work. The pros were selling it, and right back down, still embedded. So the dollar's reigning supreme at this point, and that's what you have to remember. Again, please attend our webinar on Thursday. You can just move your cursor up here, because if you didn't get an invite by now, you're not going to get one. I'm Ira Epstein. That's the way to attend, and I'll see you in the morning. Take care.